You check the number on a Tuesday. Nothing happened, no bill went through, no deposit landed. You check because it's a reflex now. Phone out, face unlock, banking app, balance. 4 seconds, done. You've done this thousands of times. The number is still there. $50,000, give or take a few hundred depending on where you are in the billing cycle. It's been sitting around that line for close to a year, maybe longer. You don't remember exactly when you crossed it because there was no celebration, no champagne, no screenshot. You just noticed one Thursday that the balance had 5 digits and the first one was a 5, and something in you loosened. Rent stopped making your chest tight. A car repair estimate stopped ruining your afternoon. You stopped Googling how much you should have saved by 30 because the answer didn't make you feel behind anymore. You got careful, quiet, good at this. Then the number stopped climbing, not because you started spending more. You still bring lunch to work. You still wait for sales. You still flinch a little at a restaurant menu with no prices on it. The discipline that built this money is still running. The money just isn't growing. And the 5 things you never got around to upgrading are the reason it's going to stay exactly where it is. Chapter 1. The 0.38% leak in your foundation. Your $50,000 is sitting in a savings account at a bank you've had since college. Maybe one your parents opened, maybe one you picked because the branch was across from your first apartment. You've never thought much about the interest rate because you've never earned enough interest for it to matter. A few dollars here, a few dollars there, enough for a coffee once a quarter. The national average savings account rate right now is roughly 0.38%. On $50,000, that's about $190 a year in interest. Per year, not per month. You probably spend more than that on a single grocery run. High-yield savings accounts, the kind offered by online banks with no branches and no marble lobbies, are currently paying between 4.00% and 4.50% APY. At 4%, that same $50,000 earns roughly $2,000 a year, about $1,810 more, for doing nothing except moving the money from one account to another. The transfer takes about 10 minutes. There's no fee. The money is still FDIC insured, and you can still withdraw it whenever you want. Over 5 years, the gap compounds. Your old account earns you maybe $960 total. A high-yield account earns you over $10,800 at 4%, assuming rates hold roughly steady. That's close to $10,000 you didn't earn, didn't invest, didn't gamble on. You just moved a number from one screen to another. Most people don't do this because they opened the account when they had $300 in it, and the rate didn't matter at $300. You picked the bank because it was nearby, or your mom used it, or someone at orientation handed you a pamphlet and you signed something. That was fine. $300 at 0.38% versus $300 at 4% is about an $11 a year difference. Nobody reorganizes their financial life for $11. But you don't have $300 anymore. You have $50,000 sitting in a vehicle built for someone with $300. The account hasn't changed. You have. That's the first upgrade. Not how you spend, not how you save, but where you save it. If something in how you think about money has ever shifted even slightly while watching this channel, subscribe. Not for the algorithm, but so the next video like this one shows up on the week you actually need it. Chapter 2. The $200 wall around everything you own. You have renters or homeowners insurance. You have auto insurance. You pay the premiums and feel covered. You aren't, not fully. Most standard auto policies cap liability at $300,000 or $500,000. That sounds like plenty until you cause an accident that puts someone in the hospital for 3 weeks. Medical bills, lost wages, legal fees, and a settlement can blow past $500,000 faster than you'd think. Once your policy limit is hit, the rest comes out of you. Your savings, your wages, the $50,000 you spent years building. An umbrella policy adds $1 million in personal liability coverage on top of your existing auto and home policies, and it covers that gap. It costs, on average, $150 to $300 a year, roughly $17 to $25 a month. You spend more than that on a streaming service you watch while falling asleep, or a cloud storage plan you forgot to cancel. For about $200 a year, you get a wall between the worst day of your life and everything you've saved. Building $50,000 slowly and quietly teaches you to accumulate, to say no, to watch a number climb. It doesn't teach you to protect what you've built. You get so focused on adding bricks you forget the building has no roof. An umbrella policy is the roof, and it's one of the cheapest things you'll ever buy relative to what it protects. Chapter 3. The form that overrides your will. There's a form sitting inside your 401k, your IRA, your life insurance policy, and your bank account, called a beneficiary designation. Most people fill it out once, the day they open the account, and never touch it again. Here's why that matters. Beneficiary designations override your will. If your will leaves everything to your sister, but the beneficiary form on your 401k still lists an X from 7 years ago, the X gets the 401k. The will doesn't matter. The form wins, every time. This isn't a loophole. It's federal law for retirement accounts and standard contract law for insurance and bank accounts. As of 2026, 56% of American adults have no estate planning documents at all, no will, no trust, no medical power of attorney. Of the 26% who do have a will, many haven't updated their beneficiary forms to match it. So the money goes to whoever you named at 24, with an HR rep standing over your shoulder when you wrote down the first name that came to mind. Updating a beneficiary form takes about 3 minutes. Log in, find the beneficiary section, change the name, add a contingent beneficiary, save. No lawyer, no notary, no cost. While you're at it, get a basic will. Online platforms can walk you through one that's legally valid for $100 to $300 depending on your state, in about 20 minutes. You name who gets what, who makes medical decisions if you can't, and if you have kids, who raises them. 20 minutes now, or a probate court deciding for your family later. You built $50,000 through small, boring, consistent choices. This is another one. Chapter 4. The container you never opened. You've been saving into a checking account and a savings account, one for spending and one for holding. That system got you to $50,000. It can't take you further. A Roth IRA is a third container. You contribute money you've already paid taxes on, and it grows tax-free. When you withdraw it in retirement, you owe nothing on the gains. And for someone sitting on $50,000 in cash, the useful part is that you can pull your contributions back out at any time for any reason, with no penalty and no tax. Only the earnings have to stay put until 59.5. In 2026, the Roth IRA contribution limit is $7,500 if you're under 50, and you can contribute the full amount if your modified adjusted gross income is under $153,000 filing single or $242,000 filing jointly. So here's the move. Keep 3 to 6 months of living expenses in your high-yield savings account as your emergency fund, and start moving the rest into a Roth IRA. Not all at once. $625 a month, about $144 a week, fills the full $7,500 annual limit, and you can automate it. Inside the Roth, put the money into a broad market index fund, something boring that tracks the total U.S. stock market or the S&P 500 and just sits there. The S&P 500 has averaged roughly 10% a year before inflation historically, though actual returns vary year to year, and there are no guarantees. The point isn't getting rich fast. It's not letting $50,000 sit in an account earning 4% when a chunk of it could be growing tax-free somewhere designed for exactly that. The habits that got you here were about hoarding, keeping cash close, watching it, controlling it. That instinct kept you safe when you had $2,000 and couldn't afford a surprise. It's the same instinct now quietly working against you. The next phase means putting money somewhere you can't check it every Tuesday morning and trusting the math the way your discipline already earned. The Roth won't feel like progress the way your savings account did. The balance will move up and down with the market, and some months it'll shrink. That's normal. You're not saving for next month. You're building a tax-free pile for a version of yourself 30 years older who'll need it far more than you do right now. Chapter 5. The cheapest thing you'll ever buy. Most people think life insurance is expensive. Surveys consistently show Americans overestimate its cost by 3 times or more. A healthy non-smoker in their early 30s can get a 20-year term policy with $500,000 in coverage for roughly $25 to $40 a month, depending on the carrier, your health, and your gender, less than most people pay for a phone plan. Term life doesn't build cash value or make you money. It does one thing. If you die during the term, your beneficiaries get the payout. If nobody depends on your income, you might not need it yet. But if you have a partner, kids, aging parents who rely on you financially, or a mortgage with someone else's name on it, it's the cheapest real protection you can buy. The catch is timing. Every year you wait, the premium climbs. That same $500,000 policy costing about $30 a month at 32 can run over $80 a month at 45 and over $150 at 50. Your health today is a rate you'll never get back. Buy term life at 30 and hold it for 20 years and you're covered until 50. By which point, if you've been saving and investing, you may be self-insured, your savings and retirement accounts doing the job the policy used to do. This is the upgrade that feels most like wasting money since you pay every month and nothing happens. You might start wondering if you even need it, thinking about canceling, imagining what else you'd do with $30 a month. That feeling means the coverage is working exactly as intended. Nothing is supposed to happen. You're not paying for a product. You're paying so that if the worst does happen, the people who eat dinner at your table and sleep under your roof aren't the ones who pay for it instead. Chapter 6. The morning after the upgrade. Add up the actual monthly cost of all this. The high-yield savings account is free. You just moved your money. The umbrella policy runs about $17 a month. The basic will was a one-time $150 or so. The beneficiary forms took 3 minutes and cost nothing. The Roth contributions come from cash you already had, just redirected. The term life policy runs roughly $30 a month. Total new monthly spending, about $47. Less than your phone bill, less than 2 takeout orders, less than the subscriptions still quietly charging your card. What did that $47 buy? A legal wall between a lawsuit and your savings. A tax-free retirement account compounding for decades. A document spelling out exactly where your money goes if you're not here tomorrow. A payout that keeps your family in their home if the worst happens. And $50,000 moved out of an account quietly losing to inflation and into one that actually earns. You didn't get a raise or start a side project. You sat down, moved some money, filled out some forms, and bought 2 policies that will probably never pay out. Nobody's making a video about what you did today, but you stopped storing your entire financial life in 2 buckets with no lids. Worth sitting with, and I'd genuinely like to hear it in the comments. Which of these 5 have you been putting off the longest, and what's the real reason, not the excuse? Chapter 7. The number starts moving again. You still check the number on Tuesdays. Phone out, face unlock, banking app, 4 seconds. But what you're checking is different now. Not one balance in one account at one bank, but a system. A high-yield account holding your emergency fund and actually earning interest. A Roth IRA buying shares of something boring and broad while you sleep. An umbrella policy and a term life policy running quietly in the background. A will and a set of beneficiary forms that finally say the same thing. The old version of you looked at $50,000 and felt finished, safe, like the hard part was over. In a way it was. The hard part was the discipline, the years of saying no, the slow work of watching a number grow $200 at a time. The next part isn't about discipline, it's about architecture. The difference between someone who saves $50,000 and someone who builds real, lasting security is 5 upgrades that cost less than dinner for 2. You already did the hardest thing. You saved the money. Now stop leaving it in the rain.